Welcome back to The Deep Dive. Today we are opening up a file on one of the most famous names from the early internet boom, a story that is conventionally told as a high-water mark of immigrant achievement in Silicon Valley. The story of Sabeer Bhatia and the creation and sale of Hotmail.
A name I think many people, especially of a certain age, will remember very clearly.
Exactly. But we aren't here today to simply, bask in the glow of that success story as it's usually told. Our source material actually challenges us to look beyond those celebratory headlines. We are going to frame this deep dive maybe differently.
Right.
Not as a history of accomplishment, but more like a forensic examination, a deeply analytical and, well, ultimately a cautionary tale. A tale of vision, market value, and maybe the self-imposed limits of self-belief in high-stakes entrepreneurship.
That's a really interesting framing.
Okay, let's unpack this. So the scene, 1997. News breaks that Hotmail was sold to Microsoft. The price tag, $400 million.
Which back then was just an almost unbelievable sum of money for a startup that young.
Absolutely seismic. And for the entire Indian diaspora especially, it was more than just a successful tech exit. It felt like a really powerful cultural moment.
Validation on a global stage.
Sabeer Bhatia instantly became this archetype, didn't he? The middle-class engineer comes over, has this audacious idea, builds something revolutionary, and sells it directly to Bill Gates himself.
The ultimate symbol of having made it.
He had symbolically and, well, definitively made it.
And that, as you just said, that's kind of where the narrative usually stops. It calcifies into this simple success story. But if you really dig into the consequences, and this is what our sources push us to do, the mission for this deep dive becomes much clearer.
Okay.
We have to analyze this piece of history through the lens of what was not done. The path that was maybe abandoned, or trying to move beyond just the price tag, which was staggering for the 90s, no doubt, to explore the, let's say, the deeper psychology evaluation and the invisible long-term cost of conceding that kind of foundational architectural control so early.
The invisible cost. I like that.
Yeah, and the documents we've reviewed for this, they are exceptionally provocative. They really challenge that standard narrative. They suggest that the sale, while obviously a huge personal financial victory for Bhatia, simultaneously marked the definitive end of what potentially could have been a global digital empire built on his platform.
Wow. Okay.
So the core question we really have to grapple with, and the one we want you, the listener, to keep turning over in your mind as we go through this, is basically this. Was that $400 million a personal triumph that launched a successful, second act? Or was it the moment a truly foundational piece of global digital identity was traded away for what has now become, really, in the grand scheme of the internet today, kind of a historical footnote?
A footnote instead of an empire. That's a stark contrast.
It really is.
So, okay, before we can even begin to tackle that valuation question properly, we absolutely have to rewind. Let's go back to 1997 and really understand the sheer, revolutionary power of Hotmail at that moment.
Yes, context is everything here.
It's almost impossible for someone using the internet today, someone who grew up with Gmail or Outlook.com, to really grasp how email worked back then. Accessing it was cumbersome, often expensive, and always, always tethered. Tethered is the key word. Your email lived on one machine, usually linked to one specific internet service provider. Right. If you wanted email outside of, say, a big corporation or a university, you were probably paying an ISP, like AOL or CompuServe. You used their specific software. You needed a dial-up modem. Remember those sounds?
Oh, I remember them well, the screeching and the beeping.
And you had to connect to that specific service from that specific location, usually your home phone line.
So if you traveled, forget about checking your email easily. Maybe you could find a terminal somewhere, try to dial in remotely. It was a huge hassle.
And if you changed jobs or even just changed your ISP because you moved, your email address, your online identity essentially, just disappeared. Poof, gone.
Exactly. And the source material really emphasizes this point. The centralization wasn't just a technical limitation of the time. It acted as a real psychological barrier to broader internet adoption. It felt clunky, temporary, localized.
Until Hotmail.
They came along and just demolished that barrier. The premise was so simple, but back then, utterly radical. Web-based email.
Just use a web browser. Anywhere.
Anywhere. The promise was distilled into those 4 kind of magical words for the time. Access your mail anywhere, anytime.
It seems so obvious now, but back then.
It was mind-blowing. By decoupling the mailbox from the specific location, the specific computer, the specific ISP, and the expensive or proprietary software, Hotmail didn't just create a new email product.
What did it create then?
It created a new mechanism for digital identity, a persistent, accessible identity layer for the average person online. It essentially democratized basic online communication.
Democratized. That's a good way to put it.
And the sources we looked at argue pretty forcefully that this wasn't just an innovation among many. It was possibly the key innovation that unlocked mass adoption of the web. It greased the wheels for that exponential explosion that happened in the late 90s.
Because suddenly, anyone with access to any web browser, maybe at a library, at school, at an internet cafe.
Exactly. They could have a permanent, free email address. It made the internet feel less like a fragmented set of services and more like a cohesive place where you could be, regardless of your ISP affiliation or where you happen to be geographically.
Okay, so the technology is undeniably disruptive, truly foundational, which makes the timing of the sale absolutely critical to understand, doesn't it?
Hugely critical.
And the negotiation story itself, I mean, it feels like an instant case study in, well, maybe undervaluation, or at least in recognizing leverage.
Oh, absolutely. Think about the moment. We are right at the cusp, the very beginning of the web's true exponential growth curve. 1997. Netscape was huge. Yahoo was the portal.
The foundations were being laid.
Precisely. The early platforms being built then were establishing the digital infrastructure, the very standards and user habits that would define the internet for decades to come. And Hotmail, at that specific moment, wasn't just another successful little startup.
It was positioned to be.
It was critically positioned to be the gateway to the internet for millions upon millions of new global users. It was the front door for so many people experiencing the web for the first time.
Wow. Okay, so Bill Gates comes knocking. Microsoft wants in. The negotiation story, as it's often told, is almost too perfect, isn't it?
It has that legendary quality. Microsoft saw the strategic importance almost immediately. They needed a consumer webmail offering to compete, to build out their MSN portal strategy.
And they make an initial offer, what was that, around $200 million?
Yeah, the sources generally cite around $200 million initially, which again, for 1997, for a company that young with relatively few employees, that was life-altering, potentially generation-changing money. Hard to turn down.
Right. And Bhatia then did something. Well, interesting. He didn't jump at it. He paused. He asked for time to think.
Which, on the surface, seems perfectly sensible, right? Dealing with potentially $200 million, you want to consider it carefully.
But according to the anecdotes, the stories captured in our sources, that very moment of hesitation, it apparently signaled something crucial to Bill Gates.
It did. Gates, being Gates, reportedly interpreted that pause not just as careful consideration, but as confirmation that Bhatia knew the platform was worth significantly more. That hesitation inadvertently revealed Hotmail's perceived value to the founder himself.
So Gates didn't wait. He didn't negotiate incrementally.
Nope. He immediately, almost instinctively, doubled the offer. Straight from $200 million to $400 million. Boom. Take it or leave it, essentially.
Yeah, that's quite a move.
It's pure Gatesian market analysis in action, isn't it? The pause wasn't necessarily a brilliant tactical negotiation move by Bhatia. The sources suggest it might have been an indication of his own internal struggle, maybe uncertainty, over the true ultimate worth.
And Gates read that perfectly.
For Gates, that pause screamed, "This thing is undervalued, even at $200 million. So the doubling wasn't an act of generosity. It was cold, calculated risk management.
Risk management. How so?
He recognized that losing Hotmail to a competitor, or even allowing it to grow independently and potentially dominate that identity layer, was a far greater risk to Microsoft's nascent internet ambitions than overpaying slightly in the short term. He needed that first-mover advantage in free, web-based digital identity. It was strategically vital.
And he got it.
He got it. And the results for Microsoft played out exactly as Gates must have foreseen. Hotmail immediately became a core pillar of their strategy. It anchored the fledgling MSN platform.
Gave it instant credibility and users.
Tens of millions of users, almost overnight. A massive, ready-made user base that eventually fed directly into what we now know as Outlook.com, Microsoft account, the whole Microsoft identity ecosystem.
Which is central to everything they do now. Office 365, Azure, Xbox.
Absolutely. It's a digital presence that underpins billions and billions in revenue today through enterprise tie-ins, cloud services, advertising integration, you name it. The foundation was arguably laid, or at least massively accelerated, by that Hotmail acquisition.
So the sources are pretty blunt in their assessment of the deal in retrospect.
They don't mince words. Most describe the deal, from Microsoft's perspective, as an absolute steal. Unbelievable value for money, even at $400 million.
And for Sabeer Bhatia, how do they frame his outcome?
The $400 million obviously made him incredibly wealthy and famous, a huge personal victory by any conventional measure. Yeah. But the sources use this very specific, quite evocative phrase to describe his position afterwards. The golden cage.
The golden cage. Explain that.
He was validated. He was rich. He was secure. But the argument goes he had essentially traded away an absolutely foundational architectural piece of the global internet, a piece that could have defined digital life for billions, for a finite, albeit very large sum of cash. He was comfortable, but contained.
Contained by the very success he achieved.
In a way, yes. Locked out of the empire he might have built.
That distinction you just made, trading architecture for cash, that seems like the absolute crux of the issue. And it's something we really need to dig into next, especially when we layer in the economic context of the late 90s.
Yes, we absolutely must anchor ourselves firmly in that specific economic moment. We're talking late 1997, moving into 98, 99, the early 2000s. This was the peak dot-com bubble era.
Irrational exuberance, as Alan Greenspan famously called it.
Exactly. Capital markets were, and this is a direct quote from one source, absolutely awash with venture capital. Money was flooding into anything that smelled like the internet.
Valuations were through the roof. Burn rates didn't seem to matter.
Precisely. Investors back then weren't primarily looking for safe, quick, profitable exits like Microsoft offered Bhatia. They were desperately, frantically seeking the next big thing, the foundational, pioneering platforms they could pour money into, aiming for monopoly scale. Think Amazon, think Google, think eBay.
They wanted grand slams, not base hits.
Absolutely. And crucially for this discussion, risk tolerance among VCs for proven innovators, especially someone like Bhatia, who had just received the ultimate validation in the form of a $400 million acquisition offer from Microsoft itself, was incredibly high. Off the charts, really.
So Bhatia had demonstrated product market fit at scale. He had the Microsoft offer as proof of value. What does that mean in that VC environment?
It means, the source argues quite convincingly, that selling Hotmail was actually the conservative choice. It was the safe path. The visionary path, the path aligned with the VC's ambitions at that moment, would have been to reject the acquisition.
Reject $400 million. That takes guts.
It takes guts and it takes a certain kind of self-belief. But that conservative choice stands in such stark contrast to what his contemporaries were doing right around that same time.
Okay, let's look at those names we need to compare.
Think about the founders who emerged in that exact same window, late 90s. Jeff Bezos at Amazon. He was facing intense pressure from shareholders and the market to show profits, maybe even to sell parts of the business. He resisted. He kept investing, kept building.
Well, famously focused on the long term.
Then you have Larry Page and Sergey Brin at Google. They got early funding, built the search engine. They didn't cash out early. They built an advertising empire around it.
And Elon Musk?
Elon Musk, with his early ventures like Zip2 and then PayPal. He sold Zip2, yes, but then immediately rolled that into X.com, which became PayPal. And even after eBay acquired PayPal for a huge sum, he didn't just retire. He used that capital as the springboard for SpaceX and Tesla.
So the pattern is clear.
The consistent factor among these figures, the ones who built truly lasting digital empires, is that they did not view their initial success, their first big product, or even significant external validation like an acquisition offer, as a stopping point. It wasn't the end goal.
It was fuel.
Exactly. They used that early momentum, that proof of concept, that influx of capital as springboards, as one source puts it. Springboards to build much larger, more ambitious, multifaceted empires. They understood instinctively that owning the platform, controlling the user relationship, controlling the architecture, was vastly more valuable in the long run than liquidating the asset for immediate cash.
And Bhatia in this comparison.
Bhatia, having built something arguably just as foundational as early Amazon or Google search, reached that first summit and made the decision to plant a flag, collect his winnings, and essentially exit the game. He cashed out his architectural control.
Let's put a finer point on the financial leverage aspect. What exactly did he walk away from in terms of funding potential?
Okay, so Microsoft offers $400 million.
Yeah.
At that moment, Hotmail instantly becomes the most validated, sought-after private internet company on the planet, bar none.
Because Bill Gates himself put a price on it.
Precisely. Gates' offer was the ultimate good housekeeping seal of approval in the tech world. So the sources argue Sabeer Bhatia could have walked into any top-tier venture capital firm on Sand Hill Road, Kleiner Perkins, Sequoia Capital, Benchmark, any of them.
And they would have listened.
Listened. They would have rolled out the red carpet. He would have been asking tentatively for, say, $10 million. He could have realistically demanded $100 million, maybe more, in immediate funding, largely on his own terms.
Just based on the Microsoft validation?
Absolutely. The market, VCs included, had complete faith in the product's potential because Bill Gates had essentially pre-vetted it at an enormous valuation. That $400 million offer wasn't just cash, it was rocket fuel for fundraising, had he chosen to use it that way.
Okay, so imagine he takes that $100 million VC investment instead of the Microsoft cash. What's the strategic path forward then?
Well, with that kind of capital, and critically, retaining ownership and control, plus his already massive, rapidly growing user base, the strategic path seems almost, well, predetermined in retrospect.
Build out from the core email service.
Exactly. Bhatia could have easily, methodically, built an entire suite of integrated internet tools, all anchored at that core digital identity provided by the Hotmail email address, which, remember, users already had and trusted.
What kind of tools are we talking about?
Think about the potential components, the building blocks that future giants later captured piece by piece. Integrated instant messaging. Why use ICQ or AIM if chat is built right into your email?
Okay, makes sense.
Proprietary search functionalities, maybe not beating Google on the whole web initially, but certainly searching within your own email, your contacts, maybe partner content. Very valuable.
Like Gmail search today.
Years earlier. Then, a robust payment system leveraging the trusted identity for peer-to-peer transfers or online checkout.
Competing with PayPal early on.
Potentially crushing PayPal before it scaled, given Hotmail's user base advantage. And foundational cloud storage, a natural extension of email attachments, a place to keep your files linked to your identity.
Basically, all the things Google eventually bundled around Gmail, or Microsoft later tried to retrofit onto Outlook.
Precisely. But Hotmail had the chance to do it first, integrated from the ground up, built around that identity layer that everyone else had to acquire or build later at much greater cost and friction.
It's actually astonishing, looking back, how clear that path seems. Hotmail had the pole position. They had the identity layer, the login, the user relationship, which is arguably the hardest, most valuable thing to capture and hold in the digital realm.
Yeah, absolute cornerstone.
And he conceded that cornerstone. He sold the architectural foundation.
He did. Which brings us right back to that really unsettling, difficult question of motivation. Why? Why sell the foundation when you're sitting on beachfront property in the fastest growing market in history?
The source material considers the more, let's say, benign explanations, right? Things like founder burnout, maybe exhaustion. Building a startup is incredibly hard.
Absolutely. Burnout is real. Caution is understandable. The dot-com bubble did eventually burst. Maybe he saw it coming and wanted to lock in his gains. The desire to secure wealth for himself, his family, his early employees, that's a powerful, very human motivator.
Can't discount those factors.
Yeah, you can't. But the material we're drawing from, it really pushes past those surface-level explanations. It drives towards a deeper, more psychological, almost sociological explanation for why this specific founder, at this specific moment, chose the exit ramp.
Okay, let's hear it.
The sources seem less interested in the financial comfort Bhatia achieved and much more interested in the potential mental constraint he might have been operating under.
A mental constraint, meaning?
Meaning, the deeper possibility suggested is a pervasive, perhaps subconscious, lack of internal self-belief. Not in his product, necessarily, but in himself as the potential builder of a global empire.
So the idea is that Sabeer Bhatia, the brilliant immigrant innovator, maybe didn't truly see himself as an equal peer to Bill Gates or Jeff Bezos or the other emerging titans.
That's the uncomfortable core of the hypothesis.
Yeah.
That he perhaps didn't possess that final ounce of audacity, that sheer self-belief required to think, yes, I can be the next global archetype of digital capitalism. I can build a multi-billion-dollar platform that rivals Microsoft itself.
Instead, he was.
Instead, perhaps he was more comfortable, psychologically, with the role of the incredibly successful vendor who sold a game-changing product to the empire builder, rather than seeing himself as the empire builder. Content, maybe, being the brilliant architect who designed the house, but then sold it before moving in, rather than the person who owns the whole neighborhood.
A successful vendor versus a systemic architect. That's a crucial difference.
It's a profound difference in mindset. And that potential lack of ultimate self-belief, that willingness to settle for validation instead of ownership, that's the thread that leads us directly into the most provocative, most complex, and frankly, most controversial thesis presented in our source material.
Okay, This feels like a major pivot point in the analysis.
It is. We're moving away from just finance and business strategy now and into sociology, history, and culture.
So if we connect Bhatia's individual decision to this bigger picture,
Yeah.
the source material uses some strong language.
It does. It explicitly describes the sale, and more importantly, the mentality that likely drove that early exit as, and I quote, an indictment of a larger civilizational condition.
Wow. Civilizational condition, that's heavy.
It's incredibly heavy, and this is the core argument we really need to dedicate some time to understanding carefully. The claim is that the $400 million exit wasn't merely a personal business decision by one founder. It reflected or was symptomatic of a much broader systemic issue of self-value, which the sources controversially tied directly to historical context, specifically for people from formerly colonized nations.
Okay, let's slow down here and define this concept thoroughly. The source calls it the invisible chain. What is that?
The invisible chain is the term used to describe this hypothesized link between, on one hand, a lower level of entrepreneurial self-esteem, specifically the audacity to aim for global ownership rather than just participation, and on the other hand, what the source calls the colonial hangover.
The colonial hangover, meaning the psychological legacy of colonialism?
Exactly. The argument, which is powerful and definitely historically provocative, is this. For generations, people in colonized nations were systematically, structurally, and psychologically taught to accept a specific, often subordinate place in the global economic and power structure.
Taught to provide labor, resources.
Right. They were encouraged, even celebrated, for providing excellent labor, services, raw materials, even technical brilliance. But crucially, the argument goes, the underlying message was often, be grateful for recognition. Be thankful when the dominant Western powers acknowledge your skill or your product.
Don't.
But don't fundamentally demand ownership. Don't expect to control the overarching architectural structures, the global platforms, the economic systems that are built using your labor or your ingenuity. Your role is to contribute, participate, and be validated, not necessarily to own and direct.
So applying that framework to Hotmail.
Applying that, when Bill Gates offered that $400 million, it wasn't just a massive cash payout in this view. It was, in a very profound societal and psychological sense, the ultimate validation from the West.
It proved they could compete at that level.
Exactly. For the entire generation of the Indian diaspora, and perhaps others from similar backgrounds watching, that validation itself felt like the primary victory. It meant more, perhaps, than the underlying asset's future potential, because it offered definitive proof. We are world-class. We belong on this stage. We have arrived.
Which leads to the source's distinction between validation and ownership.
Yes, we absolutely have to deconstruct that difference because it's central to the argument. Validation, in this context, is external. It's granted by others, often the established powers. It's inherently transient. It depends on continuing recognition, and it can be psychologically satisfying, fulfilling that need for acceptance.
Okay. In ownership.
Ownership, conversely, is internal. It's self-determined. It's perpetual, or at least intended to be. And crucially, it requires a deep, often uncomfortable, unshakable internal belief that you have the right, the capability, and maybe even the obligation to define your own value, set your own trajectory, and control your own creation, regardless of who is offering to buy you out or validate you.
So entrepreneurial self-esteem in this model isn't just about confidence in your product.
No, it goes much deeper. The sources suggest it's fundamentally the audacity to think beyond validation. It's the courage to look at an offer like $400 million, which is objectively life-changing money, validation on a massive scale, and still ask that disruptive, almost countercultural question. Why would I sell my foundational identity layer? Why would I sell the cornerstone when I can use it as the foundation to build the entire digital house myself?
And the argument is that Bhatia, while he clearly had the accomplishment of building the revolutionary product,
in choosing the early exit, he demonstrated perhaps that he hadn't fully internalized the self-esteem required for true generational ownership on a global scale. He was ready, willing, and able to claim the huge cash prize and the immense validation that came with it, but maybe not quite ready to shoulder the immense risk, the colossal ambition, and the psychological burden of actually trying to run the potential empire himself.
So the critical error, according to this analysis.
The critical error, framed this way, was Bhatia mistaking arrival for accomplishment. He proved he could build something world-class. He proved he could get the attention of Bill Gates. He accepted the accolades and the money he arrived. But he failed, perhaps, to visualize the vast, sprawling mountain range of future digital services search, payments, social networking, cloud computing that were just waiting to be built right on top of his foundational platform. He stopped at the first, admittedly very impressive, peak.
And this psychological constraint, this invisible chain, as the source calls it, was sadly not unique to Bhatia, according to this argument.
No, and this is where the argument broadens significantly. The source contends that this pattern, brilliant engineers and builders from India, from other parts of Asia, creating foundational technologies but then exiting early, was actually quite common in that first wave of the tech boom.
They took the cash, the validation.
They took the cash and the crucial external validation, which, as we discussed, felt like the main prize for many. But in doing so, they consistently allowed their Western counterparts, the Bezoses, the Gateses, the Pages, the Zuckerbergs, to acquire these foundational pieces, reinvest the profits, and ultimately build the complex, interconnected, globally dominant digital ecosystems that now dictate so much of the modern world order.
So the people who provided the initial spark often didn't own the resulting fire.
That's a good way to put it. This is why the sources use that deliberately provocative phrase, civilizational disease, when discussing self-value in this context. It implies that an entire generation, or at least a significant segment of highly talented individuals, despite providing the essential code, the engineering horsepower, the raw intellectual labor that fueled the American tech boom, systematically sold the architecture.
They became participants, not architects.
Exactly. They became, often by choice, highly valued, well-compensated participants within a structure largely designed and owned elsewhere, rather than becoming the primary architects of their own global digital ecosystem. Bhatia's individual decision, therefore, in this particular analytical framework, functions as a powerful, almost tragic mirror reflecting that larger systemic psychological constraint of that specific era regarding self-worth and the ambition for ownership.
Wow, okay, that analysis completely reframes how we might view that entire period.
Yeah.
It demands we see those early lucrative exits not just as individual business wins, but potentially as collective lost opportunities for building global structural power and retaining control over foundational digital infrastructure.
It's challenging perspective, for sure.
And having established that framework, that deep psychological and sociological context, is absolutely essential before we move to the next part. The thought experiment that the source outlines, the alternate timeline.
Yes, the what if.
The what if, where that $400 million sale didn't happen, where the initial validation compounded not just into personal wealth, but into a potential, what's the figure they use, a $400 billion legacy.
That's the speculative, almost mind-bending figure they float. And this is where it gets really interesting because it attempts to quantify the potential cost of that missed self-belief, that choice of validation over ownership.
So this thought experiment isn't just fantasy, it's trying to map out a plausible alternative based on Hotmail's initial position.
Exactly. It's crucial because it takes that somewhat abstract concept of self-belief and tries to translate it into tangible financial outcomes and potential market milestones. It's an exercise in imagining the power of compounding, not just compounding capital from VCs, but compounding innovation built layer by layer around that irreplaceable core asset, the Hotmail digital identity platform.
And the argument is that Hotmail was uniquely positioned for this.
Uniquely positioned. It had the first mover advantage in free webmail at massive scale. It had millions of users who trusted it with their primary online identity. It had the technical foundation. The sources argue it had everything necessary to become the world's first truly global super app.
A super app, like WeChat in China today.
Precisely like WeChat, but potentially years earlier, and on a global scale from the start. Long before the term super app even became mainstream in the West, Hotmail had the ingredients: communication, identity, and a massive user base to leverage for adding other services.
Okay, so let's walk through this alternate timeline. Let's break down the specific, plausible milestones that a hypothetical, self-believing, ownership-focused, Bhatia-led Hotmail super app could have achieved, assuming he rejected the Microsoft offer and took VC money instead. Where does it start?
Right, so timeline starts late 1997, early 1998. Step 1. Reject Microsoft, secure that hypothetical $100 million plus in VC funding, crucially retaining majority ownership and strategic control.
Okay, funded and independent, what's the first big move?
The immediate priority, say by the year 2000, has to be consolidating communication dominance. You leverage the email base. Hotmail launches integrated, seamless instant messaging directly within the web client, no separate app to download, no new account needed. Your Hotmail login is your chat login.
You're taking on AM, ICQ, MSN Messenger directly.
And arguably with a massive advantage because it's already where users live for email. At the same time, you enhance file sharing capabilities, making it trivial to send larger files than standard email attachments allowed back then. You basically own the core personal and semi-professional communication stack. Email and chat, totally integrated.
That alone would have been huge years before Gmail offered integrated chat.
Absolutely. It establishes total dominance in basic online communication, potentially years before Google even launched Gmail, and certainly long before dedicated mainstream messaging platforms like WhatsApp or Facebook Messenger took hold globally. Hotmail could have been that platform.
Okay, fast forward a few years. It's maybe 2003. Hotmail is the undisputed king of online communication, tens, maybe hundreds of millions, logging in daily. What's the next logical vertical to add, leveraging that sticky identity?
Finance. It's the logical next step. People trust you with their communication identity. The next frontier is their transactional identity.
So Hotmail launches a what? A payment system?
Precisely. Let's call it HotPay, a peer-to-peer payment system seamlessly integrated into the user's established Hotmail identity.
How would that work?
Think about its potential competitive advantage. PayPal existed, but back then it was still relatively clunky, often reliant on slower bank transfers, ACH, and required a completely separate sign-up and verification process. HotPay could bypass much of that friction.
Because you already have the user's verified identity.
Exactly. If you already trust Hotmail with your primary digital identity, maybe you've already provided some verification details. Linking your bank account or a credit card becomes a much smaller leap of faith. Just a few clicks within the interface you already use daily.
So almost zero friction for adoption for a massive existing user base.
Potentially near zero friction. This could have, the argument goes, severely stunted the growth of PayPal, maybe even suffocated it before it achieved true mainstream scale. HotPay, built on the Hotmail identity layer, could have transformed Hotmail from just a communication utility into a foundational financial platform as well. Communication and basic commerce intertwined.
Okay, that's a powerful combination. Now, push forward again. It's maybe 2005. The web is maturing. Information overload is becoming a real challenge. What's the next move for the Hotmail super app?
By 2005, Hotmail is this theoretical nexus of communication and finance. The next logical step is to leverage the immense user data they possess, anonymized, of course, but still powerful data on what emails people open, what links they click, maybe even what types of transactions they make via HotPay.
Use that data for?
To introduce integrated search and personalized content feeds. Think integrated web search results, perhaps biased towards trusted partners or user history, appearing right alongside email search. And customized news feeds, content recommendations, maybe early social features, all surfaced within the Hotmail interface based on user behavior and preferences.
So this is the moment Hotmail explicitly tries to become the super app, the single portal for everything.
This is that moment. Communication, email, chat, commerce, HotPay, and now content discovery, search, feeds. All unified within the same ecosystem under a single login. They would be competing directly with Google's expanding ambitions in search and content, yes, but potentially doing so from the incredibly entrenched position of already owning the user's primary login ID and communication hub.
That's a very different competitive dynamic than Google faced historically.
Very different. And finally, let's jump to around 2010 in this alternate timeline, building on that early file sharing capability we mentioned.
Cloud storage.
Absolutely. Hotmail launches Hotmail Cloud. But critically, it's not just another storage service. Because it's integrated from the start, it becomes the default, seamlessly embedded storage solution for all email attachments, documents created or shared via Hotmail, photos uploaded, maybe even files from integrated partner apps.
So not an add-on, but the fabric of the service.
Exactly. Because Hotmail is already tied to their core digital identity, Hotmail Cloud would automatically, naturally become the default repository for users' digital lives, photos, personal documents, professional files, all intrinsically linked to the identity they use every single day.
And the timing.
This would have likely preceded the widespread mainstream adoption of standalone services like Dropbox and, crucially, Google Drive or Microsoft's own OneDrive as deeply integrated defaults. Hotmail could have owned the creation and the storage layer of digital life for hundreds of millions, maybe billions of users.
Wow, just laying it out like that. The sheer scale of this hypothetical alternative universe is, well, it's breathtaking.
It really is.
Yeah. By, say, 2020, in this alternate reality, the name Hotmail wouldn't be a piece of internet nostalgia. It wouldn't be the butt of jokes about old email addresses.
No. It would likely be one of the top 5 most valuable, most influential digital brands on the entire planet. It would be synonymous with digital identity, daily communication, online finance, cloud storage, perhaps akin to how we collectively rely on our Google account or Apple ID today to anchor and manage huge swathes of our digital existence. Hotmail could have been that anchor.
This whole analysis is alternate timeline. It transcends simple financial math, doesn't it? Was the core failure, if we accept this framework, purely financial, not securing the VC money? Or was it fundamentally psychological?
The sources lean heavily towards the psychological, arguing it's the root cause. The lesson here, they contend, isn't just about the missed opportunity for financial compounding, turning $400 million into $400 billion. It's about the failure of intellectual and visionary compounding.
Explain that difference.
Bhatia demonstrably achieved the first jump. He had the brilliant idea, the technical execution, the market timing for the email revolution. He secured the initial validation. That was huge. But, the argument goes, he lacked the expansive vision, the sustained self-belief, and perhaps what the source called the internal sense of right to execute, the necessary successive, iterative jumps required to build an enduring, multi-layered platform.
He stopped after the first jump.
He essentially sold the single, incredibly valuable seed, the core identity layer, instead of protecting it, nurturing it, and allowing it to grow into the vast digital forest that could have sheltered and arguably profited immensely from billions of users.
That metaphor, selling the seed instead of growing the forest, that really captures the essence of this missed opportunity narrative.
It does, and analyzing this road not taken, this potential empire left unbuilt, is incredibly important, the sources argue, because it allows us to shift the focus. We move away from just one individual entrepreneur's bank account and towards the larger lesson, which is about the mechanism, the process, by which entire communities, perhaps even civilizations, learn to value themselves, assert themselves, and claim ownership within a new economic paradigm, in this case, the digital economy.
And the sources specifically highlight the role of the Indian diaspora in this context.
Yes. They emphasize that while the Indian diaspora provided an absolutely critical mass of exceptional technical talent, the engineers writing the code, the project managers, the sheer brain power and labor that undeniably powered much of the American tech boom in the 90s and 2000s.
Initially, very few from that group ended up owning the foundational architecture. Is that the point?
That's precisely the point being made. They were often the highly valued, indispensable participants, the essential cogs in the machine, the brilliant minds solving the hard technical problems. But, the argument continues, they were rarely the principal architects holding the blueprints, controlling the strategic direction, and ultimately owning the resulting global platforms.
And that failure to own the architecture, as we discussed, the source links back to that psychological constraint, the potential comfort with external validation over the harder, riskier path of self-determined ownership.
Exactly. Ownership, as the sources frame it, requires more than just technical skill or a good idea. It requires a deep, almost cultural level of self-belief. A confidence rooted in the conviction that your community, your civilization, can and should produce visionaries who build the future, not just participate in it.
And Bhatia's choice in 1997.
Bhatia's choice, in this interpretation, signaled that perhaps for that first generation, achieving participation at the highest level and receiving that coveted validation from the established power, Microsoft, felt like the ultimate prize. Ownership of the empire itself was maybe a step too far, psychologically.
But thankfully, the story doesn't end there, right? The analysis suggests that this lesson wasn't lost.
No, absolutely not. And this is crucial. The subsequent generation of leaders, particularly those from the Indian diaspora who rose to prominence later, were watching. They saw what happened with Hotmail and other early exits. They internalized the even harsh lessons presented by these cautionary tales. They understood the immense strategic cost of selling foundational identity architecture too early.
And we see this realization, this shift in mindset, reflected powerfully in the second wave of leaders that the source material explicitly cites.
Yes. Think about the individuals who ascended not by creating something and selling it quickly, but by taking control of, transforming, and ultimately owning vast, complex digital ecosystems.
Names like
Sundar Pichai's rise within Google, eventually leading the entire company, overseeing its massive ecosystem. Satya Nadella's absolutely pivotal architectural transformation of Microsoft itself, steering it away from Windows centricity towards cloud dominance, with Azure a move focused entirely on owning the next foundational layer.
Nadella fundamentally rebuilt Microsoft's identity around architecture he controlled.
Precisely. And crucially, the sources also highlight someone like Sridhar Vembu, the founder of Zoho.
Zoho's philosophy seems quite different.
Very different and very relevant here. Vembu's entire approach emphasizes long-term vision, sustainable growth, often bootstrapping instead of massive VC rounds, and significantly prioritizing building infrastructure and talent within India itself. It feels like a direct philosophical rejection of that early exit, validation-seeking mentality.
So the second wave represents a conscious shift towards building, expanding, and holding on to the infrastructure.
Yes. It marks, according to this analysis, a profound shift in awareness, an understanding of strategic patience, the compounding value of ownership, and a deeper confidence in their own ability and their community's ability to build and lead global platforms. A new level of self-value and strategic, enduring ambition seems to be at play.
So Sabeer Bhatia's ultimate contribution, ironically, might be less about the $400 million and more about the lesson learned from his exit.
That's the powerful conclusion the sources point towards. His personal choice, viewed through this lens, has this enduring, perhaps accidental contribution, the potential empire he left on the table, that vividly imagined road not taken. It served as arguably the primary, most potent instruction manual for those who came after him.
His story became a stark reminder of, as one source put it, what happens when vision yields to validation.
Exactly. The perceived critical mistake became the map for the next generation, guiding them towards a different set of priorities, towards ownership, towards building the whole house, not just selling the foundation.
Okay, so wrapping this all up, we've covered Hotmail's revolutionary nature, the unique context of the dot-com boom, the crucial leverage Bhatia potentially had, the complex psychological factors around validation versus ownership, the provocative invisible chain theory, the staggering alternate timeline, and the lessons learned by the next generation. So what does this all mean for us today? For anyone listening, whether you're maybe running your own startup, trying to navigate a complex corporate structure, or just looking for an edge in your professional life, what are the really core takeaways from this deep dive?
I think the inherited lesson, distilled down, is fundamentally critical for the modern digital age we live in now. And it's this: self-belief, that deep internal conviction in your right and ability to own and build, often compounds faster and more powerfully than capital alone.
Faster than capital. Explain that.
Money can almost always be raised, especially for a good idea with traction. Capital is, relatively speaking, abundant. But the sheer necessary audacity, the internal permission you give yourself to believe that you deserve to own a foundational piece of the future, and not just build it and sell it off for validation. That is the true, scarce, non-negotiable asset in long-term value creation.
So don't just focus on the funding. Focus on the foundational self-belief.
Absolutely. And we need to internalize the deeper wisdom that the sources are trying to impart, which is almost philosophical. You don't sell your roots, you build from them. Meaning your core innovation, your foundational platform, your unique insight, that's your root system. Selling it off too early is like selling the roots of a tree for a quick profit. Building from them means nurturing that core, adding layers, growing branches, letting it mature into something much larger and more enduring.
Hotmail, in this analogy, was the open door.
Hotmail was the open door to a potentially massive integrated digital future. Bhatia, understandably perhaps, walked out of that door with the cash and the validation, the golden cage. The clear expectation, the lesson passed down for the next generation of builders and innovators, is to have the courage to walk through that door, reject the allure of the quick, validating exit, and focus entirely on the harder, longer, but ultimately more rewarding task of building the entire house. Own the architecture.
That's a powerful call to action, which leaves us with our final provocative thought for you, the listener, to consider as you go about your day after this deep dive.
Let's hear it.
Today, right now, we see countless hot startups achieving massive, sometimes seemingly irrational valuations. Many founders are celebrated for achieving quick, lucrative exits, often selling to the established tech giants. The cycle continues. So, the question to ponder is this: how many of these current celebrated exits are, perhaps unknowingly, repeating the Hotmail mistake for a new generation? How many founders right now might be selling off a truly critical piece of future global identity architecture, social infrastructure, or foundational AI technology, primarily for that short-term hit of cash and validation?
Are we just watching the same pattern play out again?
Are we, as a global tech community, still perhaps systemically undervaluing the long-term strategic importance of ownership? Are we watching a continuous cycle of brilliant minds building civilization's essential digital infrastructure, only to sell it off to the highest bidder, rather than demanding the right and finding the conviction to own, evolve, and govern the very civilization that infrastructure helps create? Something to think about.